What a day. You're seeing Liz Truss resigning in the UK. You just built a new headquarters there. Clearly, you have a large presence in the region. What do you think about the turmoil in leadership?
Well, obviously, the UK, Sonali, has been going through a very challenging period. From our perspective, we tend to take a long-term view. You referenced us committing to build a new headquarters on Berkeley Square in the heart of London. That's something we're very proud about. We have more than 500 employees there. We have an enormous amount of holdings in the UK across our real estate and private equity portfolios. And we're big believers in the UK long term. Near term, there are challenges, obviously, around energy, around inflation. But long term, the UK has some great attributes. It's a country that has a real magnet for talent, particularly in London. It's got rule of law, transparency, liquidity, an English-speaking population. And so we think over time, capital will come back to the UK. And as investors, sentiment has been really negative. The pound's down 17% year to date. The stocks in the UK market are trading at less than nine times earnings. And that to us represents opportunity. So the near term may be tough, but as long-term investors, we like to look at these things and think about the opportunity to make investments into dislocated moments, which is clearly what we're seeing now.
So let's talk about the numbers for a second, because on one hand, you have profit that is lower than a year ago, but on the other hand, you did still bring in almost $50 billion. I'm really curious here as to how those things really square off. Do you think that this environment will get tougher for a firm like Blackstone, but investors are seeing through it? Or do you think that the tough environment here is going to keep people away from private markets for some time?
Well, I would say as it relates to our quarter end results, we're really proud. And we're proud because our mission is to deliver great returns for our customers. And that's what we did in the quarter. With markets down across the board, we protected capital, we outperformed. And that's really driven our business. And that's why you continue to see these inflows into our various products. $45 billion in the quarter, $183 billion in just 9 months. That's what our business is, deliver solid results, and investors entrust us with more capital. Markets are more challenging, but if you look back over time at Blackstone, through all sorts of downturns in the early 2000s, early 90s, 08, 09, the mini downturn in 2020, we outperformed. And so I think what you're seeing is a continued vote of confidence in our firm and in the breadth of our platform across real estate and private equity, infrastructure, credit, hedge funds. By delivering results, we attract more capital, and we continue to focus on what we do, but we recognize it's a tougher economic climate, it's a tougher investment climate.
One area that there was real outperformance was private credit, especially when you compare it to liquid credit. How do you see that playing out throughout the rest of the year into next year? Do you think it'll continue to be that outperformer, and do you invest more in one area than the other?
You know, I think private credit is well positioned, and liquid credit, frankly, because what you're seeing now is base rates have moved up significantly. In both of those areas, we invest in floating rate credit. So you get the benefit of base rates going from 0 to 4%. Spreads for non-investment grade companies have gone out another 200 basis points. And so overall, you're earning 10 to 12% unleveraged, senior in the capital stack, which to us is very attractive. And even if we see a little more in the way of defaults, we think, given our focus on senior credit, and today we're sitting at a place with almost no defaults in the system, we think this is a very attractive risk return. So investors today are looking at private credit, the benefits from floating rate, the benefits from being senior lenders, and this is an area of real strength for us and what we can deliver to our customers.
You're talking about economic challenges, you're talking about potential defaults in the future. How do you feel about the potential for a recession and how deep that kind of event might be?
So what I'd say is the Fed is beginning to achieve its goal of slowing the economy and slowing inflation, although there's still a fair amount of momentum in the economy. I think about them a little bit like a doctor administering medicine. They put a shot in your arm, that has hit capital markets immediately. You feel the pain in stocks and in bonds down 20, 15% respectively. We're seeing that move out into capital goods, furniture, for sale housing. We're really seeing a slowdown there as mortgage rates go up. But then it's taking longer to get to the general employment market. Unemployment still 3.5%. Areas like travel and leisure are still pretty strong. But if you talk to our companies, they are becoming more cautious. Their CapEx plans are being lowered. Their hiring plans are slowing. And so we see this happening with a lag. I was talking this week with a developer of apartments who's building this year 15,000 units across the U.S., major developer. And he said next year he's cut his plans by 75%. And so if you think about next year, what that means for the economy and employment, it's going to be tougher. So I think we're beginning to see this slowdown. I don't know if it'll technically be a recession, but it'll be a material slowdown in economic activity, and I think a material slowdown in employment.
How long does that last for? A 75% reduction that you're talking to is significant to your point, and that has a drag on it. Are you seeing difficulties throughout the whole of 2023 into 2024 at this point?
Well, the 75% relates to construction, which tends to be very sensitive to cost of capital. But I think 2023 for those type of businesses will be challenging, the most capital intensive businesses. So construction will go down. One of the interesting things for us as the largest investor in commercial real estate is when you come out the other side of this, you're going to see a lot less construction, and that is beneficial for existing real estate. And so the key is to have staying power to get through an environment like this, because when you come out, the fundamentals will be even better. And that's one of the things that gives us confidence about our portfolio.
Curious about your view on the apartment sector, residential real estate, and the idea here that there is a lot of short-term funding in that market still. Do you think that there will be a lot of pressure there as rates go up?
So I think it's a bit of a tale of two cities. I think as it relates to for sale housing, with mortgage rates up so much, you're going to see that slow, and you've begun to see that in a really meaningful way. When you get to the apartment market, there people have to live somewhere. So I think the lack of for sale, and we'll see a slowdown in commercial apartment building, that'll lead to strength in underlying apartment rents. They're beginning to slow, but they were running at high double digits at the beginning of the year. Now they're high single digits. So still strong, but slowing, reflecting that some of this inflation is coming out of the system. But long term, the underbuilding in housing in the U.S. since the financial crisis really underpins this sector. And it's one of the big differences if you went back to 08, 09, when we had overbuilding and overleverage in housing, similar story in commercial real estate, and banks that weren't particularly healthy. Today we go into this downturn in a much better spot. Doesn't mean there won't be slowdown, doesn't mean there won't be pain points, but I think overall we'll be a lot better off than we were back then.
So are you ready to deploy capital more in the real estate sector, kind of given where we are, or does something need to shake out before you're ready to double down?
Well, in real estate, the challenge is when you get to a moment like this, people tend to pause, right? They want to see what's going to happen. Lenders slow down a bit, sellers pause a bit. And so it takes a bit of time for the market to reset. And so I think the opportunities are ahead of us. There may be some opportunities on the screen because some of the public real estate stocks have traded off pretty materially. But I think I feel pretty good about the money we have to invest. We've raised a very large opportunistic real estate fund. I think the timing of deployment will be quite good.
John, there's a few factors here that you've said are facing slowdowns in terms of pricing. Does that mean you think inflation has peaked, or have we not seen the worst of it yet?
I think inflation has reached the top. I think it is starting to come down. I think it may come down more slowly than people are hoping because of the stickiness in the shelter cost and the stickiness in labor markets. But as I said, I think the Fed has had a positive impact in terms of slowing things down, both economic activity and inflation. So I think it'll happen. I think people may be a bit disappointed in the next few months, but in time, we're going to see inflation come down. How easy is it going to be? I think it'll be easier to go from 8 to 4 or 5. Getting down to 2 may be tough because of some of the structural challenges, but I think we're going to begin to see inflation come down as the economy cools.
John, you're at $951 billion in assets under management. You had $45 billion nearly in inflows in the quarter. Are you going to hit $1 trillion this year?
Well, it's always hard to say with confidence. It's a function, obviously, what happens with markets and our ability to continue to raise capital. So I'm not going to put an exact timing on it, but definitely in the not too distant future, we expect to cross that mark. But to us, the key thing is not about the AUM, it's about delivering for our customers. And so what I'm most proud about is being able to do that.
One more question for you before I let you go. You know, it's interesting. There's been a lot of talk about private markets being shielded from a lot of the disarray in the public markets. But when you look at Blackstone stock, it has fallen more than a lot of the big banks out there. What do you think that's about? Do investors just feel you're more exposed to the real economy? Are they worried about the leverage in the system and the cost of borrowing for buyouts? What is it that investors are latching onto here in the decline that may be making you decline more than some of the large banks that are exposed to the more public markets here?
Yeah, I think investors are generally cautious in an environment where asset prices are declining, and they view us maybe as a derivative play on that. And I think what's lost is the mega trends here, which are alternatives, our space, are growing very quickly, have been doing so for a long time. We're the leader in that space, which we think is a great spot to be in. We're continuing to broaden out what we do, who we serve, moving into insurance and infrastructure, performing credit, core plus real estate. And so we're really broadening out our business, making it more recurring in nature. And yet, to your point, as you said, we still have traded off significantly. I'd also point out we have virtually no net debt, no insurance liabilities. And if you look at our company, we've delivered earnings over the last 10 years. Distributable earnings have grown at triple the rate of the stock market. And yet today we pay on a dividend yield also triple the rate of the market. So there are still a lot of people who are concerned about our model. We feel like we continue to execute for our investors, we continue to grow, and over time, the stock market will recognize the power of this franchise. We're patient, we're focused, we plan on delivering, and yes, it's a tough market, but over time, I think people will recognize what we built.